I'm joined by Sharik Merchant. He's fund manager at White Oak Capital Mutual Fund and looks at this pocket very, very closely. Sharik, good having you. Thank you so much for taking time out. This is Neeraj here. Good afternoon.
Hi, Neeraj.
This was our simplistic version of talking about REITs. I would love for you to tell us why is it that you guys at White Oak study REITs so closely? What is the investment case of REITs for institutional investors or retail investors?
Sure. So, Neeraj, I think you put it very beautifully when you started, giving an investor access to a piece of real estate, which typically a ticket size would be restrictive. What REITs provide investors is that you get access to the highest quality of grade A real estate at by buying units of that real estate. Now, what is not uh, always appreciated as well is that when you're looking at equities, let's say a company that is a developer, what that developer does is it buys land, it constructs the real estate, and if it's, let's say, commercial real estate, it will let it out and then enjoy the rentals. So it comes with a completely different level of risk profile because there are several nuances and challenges associated with going through the entire cycle in developing real estate besides the time itself. What a REIT does is that it takes on developed real estate. 80% of a REIT portfolio minimum is mandated by the regulation to be already developed and rent generating. So the risk profile, because it is largely let out real estate, it reduces an investor's risk profile and therefore enables someone to access high quality, professionally managed grade A real estate at a significantly lower level of risk. Now, this does not necessarily only mean commercial real estate. When we are talking about REITs, it also includes asset classes like malls, which have a completely different tenant profile. And the drivers for, say, commercial real estate versus mall real estate can be very different. So, from an investor's point of view, it gives you access to different levels or different types of income generating streams at different levels of risk profiles. And so, when, like you said, where does it fit into an investor's portfolio? The where it sits is somewhere between debt and equity, where we think of returns closer to equity like, but typically lower than equity, but at risk profiles that are significantly lower than equity. So your risk adjusted returns tend to be fairly healthy. So that's why, as an asset class, we really like REITs, and I think they're at a very, very nascent stage today. They're only going to grow meaningfully from here.
Hi, Sharik, hi, Mahima also joining in. Just want to understand as to what is your expectations as to how REIT markets will evolve in the next 3 to 5 odd years, and considering if a person wants to go ahead and invest in a REIT today, how much of a percentage in terms of his or her total portfolio should be REIT per se, because we always say, right, that do not put all your eggs in one basket. What's your reading there?
Got it. So, from a growth point of view, maybe I'll point you to a few statements that large infrastructure players like Blackstone or Brookfield have recently made. Their commitments in India, which are in the tune of $50 billion each, they want to double this portfolio over the next few years. These go into infrastructure assets, they'll go into InvITs, they'll go into REITs. And at some point, these assets will come into the market to public platforms, allowing smaller investors and other funds to be able to invest in them. The size of the assets today is roughly 1 lakh crores for REITs, slightly higher for InvITs. Over the next few years, we think that this sector will grow multifold in size as more and more assets can be REITified. or can also come into InvIT structures. And there was a recent study that said that the pool of assets that are today available that can come into InvIT structures are close to 20 lakh crores. So that is the kind of potential that you're seeing of this sector over the next few years.
And that,
And
sorry, you continue.
yeah, and in terms of where this sits in an investor's portfolio, you're very right, or cannot put all eggs in one basket. This becomes a very effective tool to diversify portfolios. The traditional mindset has been to look at investments through an equity lens or a debt lens. But with REITs coming in, what this does is that it is giving you a completely different profile of income and risk assets that can add to your portfolio. Remember, till now, this asset class was just not available. Because you now have access to this asset class, you can think of this very differently in terms of how you want to allocate. There are again nuances to this. I don't think you should think of all REITs or all InvITs in one basket. They also within them come with very different levels of risk and return profiles. So within REITs and within InvITs, you have the ability to diversify.
Sharik, what within this landscape? I mean, because there are different kinds of REITs, right? Some manage malls, some manage commercial real estate, right? At some point of time, we'll have warehousing REITs as well. I'm pretty certain of it,
Absolutely.
if not
Yeah.
already. So, what, to your mind, which are the better ones for an investor to look at when they are looking at REITs, and what's the average return that one should anticipate? I mean, there are some people talking about 9% being good, but at a point of time, when the markets are a bit lower, even 12% was available as a yield, right? So can you fill us all of these gaps with?
Yeah, so like I said, there will be different risk and return profiles which you have to keep in mind. When you're thinking about commercial REITs, the underlying is commercial assets where your drivers will be how commercial real estate picks up in India. Essentially, how GCCs, which are the largest takers of grade A real estate in India, how GCCs grow in the country. When it comes to mall REITs, you're effectively taking a call on discretionary consumption in India growing. And as long as you believe that discretionary consumption in India will continue to grow, mall REITs become a very interesting play. Also, remember that there is very limited supply of high quality retail space in India. If as a brand who wants to expand, there is limited high streets. You need to go to malls. Where will you get top quality space? So the ability of malls to charge greater rentals is only growing. Similarly, even for commercial real estate, you will see that there is a very wide divergence between grade A spaces and grade B spaces. REITs, because they are professionally managed, have the ability to invest in capex within existing buildings. They uplift the quality of the building and therefore start to command premium rents.
Sharik, so here's my question. If somebody buys in into a REIT, any REIT structure which they might be comfortable with, let's assume after analysis, at a yield of maybe 10%, 11%, what have you, would you reckon over a period of 5, 7, 10 years, you earn that yield of 10, 11% plus the upgradation in the prices of property, and therefore a CAGR return of maybe 13, 15, 17%? I don't know what the number is. I'm just throwing numbers at you, but
Sure.
that kind
So
of return could be possible?
let me give you some perspective here. So today, for REITs, yields tend to be in the 6 to 7% ballpark. But remember, they are also very tax efficient. But what is underappreciated is the growth element. Typically in India, a lot of you may be aware, rentals escalate at 15% every 3 years. So these are contractual rental escalations. Over and above that, you have other levers like increasing occupancy, mark to market on the rentals, new assets that are coming into the REIT, either through M&A or where they have land available and they are constructing on that land. So these become growth drivers for REITs. So when you put all of it together, which is a combination of the yield that you're getting today, plus the growth that is associated with them, I would believe that a low to mid-teen number is where most REITs would sit. Or to put it in different words, to create a benchmark relative to equity, I would suggest that it would be marginally lower than what equity returns would be.
Sharik, just wanted to get a sense of how these are tax efficient, because if I'm not wrong, there are three sources of income through which REITs generate income. That's rental, capital gains, as well as dividend income, and all three of them are taxed differently, if I'm not wrong. So how are they tax efficient? Just wanted to understand that.
Right. So I'll explain all three of those components. When it comes to equity dividend payouts, dividends are taxed at your maximum marginal rate. So you're paying full tax on that dividend. In the case of REITs, the dividend component of the payout is fully exempt to the taxpayer. The second component is the interest component, which is fully taxable, comparable to dividends of equity. And the third component is a component called return of capital. Now, in return of capital, what is done is that the payout that is received by you is reduced from your cost of acquisition. And then at the point at which you sell the REIT unit, you will pay capital gains on that amount. So you defer your tax liability and you reduce it at a lower rate, because capital gains in India are charged at a lower rate than your maximum marginal rate of tax. So net, the overall REIT investment tends to become more tax efficient than typical equities.
Got it. Sharik, lovely talking to you. Thanks for giving us this, what some people might call a primer, but it's always good to revisit what REITs exactly do, because for a lot of people, this subject is not as well discovered. So thank you so much for giving us a lowdown on this.
Yeah, thank you for having me.